This whole picture leads to an overarching theme that's causing market concern, that an appeals court has ruled 7-4 that most of President Trump's tariffs on foreign goods are illegal, with a potential showdown, a probable showdown in the Supreme Court, a distinct possibility on this issue. Corporate spending could freeze amid the uncertainty. But does that mean investors should freeze? And considering the U.S. equity market still has 10 companies with a market cap of $1 trillion or more, and also the economic data have so far held a solid grip on the bar, could this September be different from all the other nightmarish Septembers? Let's get right to the floor show. CFRA Research Chief Investment Strategist Sam Stovall, who is the walking encyclopedia of these kinds of data points, is here with us. Sam, could this be the September that bucks the trend and isn't so bad, even though we have a rough start right now?
It's always a possibility, Liz. Always also a pleasure to talk to you. When I look back to World War II and I see those years in which we've had all-time highs, 20 or more, as this one has had, the market itself did very well in the final 4 months of the year, rising about 5.5% and up about 90% of the time. And even a little bit of positive news is that September tends to rise slightly more frequently than fall, which is better than the average for all Septembers since World War II. So, yeah, slightly better chances this year than in the past.
Okay, but let's look in the here and now. Let's move the entire picture to what is happening. So tech has been the grand leader over the past year and a half, 2 years, and everybody's talking about rotation once again. It was about half a year ago that people started to focus on rotation, and then that kind of died down. But where is the rotation now that you believe in, that you think is the right pivot?
Well, first off, rotation is not bad. Retreat is bad. And while we are retreating today, I think that the market is going through a rotation in the near term, primarily because tech has done so well over the last several years, not just year to date. And also, we have seen a lot of technology industries up more than 75% since the April 8th low. So I think investors are taking profits because in the period ahead, we don't have that many catalysts. Their earnings are not going to be coming out again until the second week of October. So I think investors are taking some profits in the technology shares and gravitating towards some of the deeper cyclicals, such as energy and materials, but also sticking with some of the banks as well as entertainment companies that should benefit from a lower interest rate.
Can I push you a little bit on no real catalyst because the next earnings season reports start a couple of months from now? What about the econo calendar? I was looking at that for this week alone. Several huge pieces of data are on the way, not the least of which is Friday. We have the August jobs report coming out, and that's been a very important piece of what obviously the Federal Reserve is looking at. The Federal Reserve wants to see, is the job market holding up? Do we still have some type of strength here? Now, the expectation for August non-farm payrolls is to see a build of about, 70,000, 75,000. That's the expectation. July was 73,000, a little bit anemic there. And unemployment rate's expected to be at 4.3%, July 4.2%. And then you've got, back it up, ADP, that is the sort of the precursor. Usually comes out on Wednesday, but since we had the shortened week here, it's coming out then. And then the JOLTS is coming out tomorrow. JOLTS is job openings and labor turnover. Could one or all of these start to swirl and turn the markets if they come in weaker or stronger?
Without a doubt, Liz, the market does have to run a gauntlet of challenging economic reports. You just mentioned the employment report that will be coming out at the end of this week. And yeah, if it confirms last month's weak reading, if we see a sharp uptick in the unemployment rate, that could certainly be challenging. We're also going to be looking at both inflation points, the consumer price index, producer price index, before the upcoming FOMC meeting. add to that retail sales and industrial production. So they could end up being challenging. Industrial production represents all output of factories, mines, utilities. So it's a pretty good indicator of what the economy is doing. So certainly our belief is that they will be showing favorable results, but they certainly could upset the mix.
You know what's upsetting the mix slightly today? The 30-year Treasury yield. It got within a tiny percentage of 5% earlier. I think the session high for the 30-year yield was 4.999%. Right now, it has pulled back a bit off that. I believe we've got the 30-year at the moment at about 4.978. And so what do you make of that? Why do you think Treasury yields on the longer end of the curve, the 10 years up, 5, 7, 2, why do you think they're moving higher?
I think the concern is that while the Fed can control the short end of the yield curve, it cannot control the longer end. And I think the response today is in response to the court indicating that many of the tariffs are probably not legal and at least will have to be reevaluated. Also, if the worry is that too many doves will be on the Federal Reserve list, and as a result, then really pushes for an aggressive easing cycle. The worry is that that could refan the flames of inflation and as a result require the longer yield to be higher in order to account for that inflation.
Sam, thank you very much. So we'll continue to watch whether it's the industrials or the regional banks, things that you feel the rotation deserves from investors' money.